What is up, investors? Back again, another stock analysis video. This time we're taking a look at Roku, ticker symbol ROKU. Often gets compared to Netflix, but they run a slightly different business model. They have more ads and ad-based entertainment on their platform, whereas Netflix is primarily just a subscription base. So an interesting company, and one that I think you definitely want to take a look at. So notice that this company for the longest time here, or for a long time, traded in this $30 to $40 range, but really started to climb as revenues and growth of the platform really started to take off. And this $100 price tag kind of like it magnetized the stock for a minute, and then boom, every time this stock gaps up, it comes back down to this almost exactly $100 level, then goes back up. Now we had the COVID-19 low, kind of blew through every stock's low point, but this stock actually went right back up to close to 100, and then we saw it sell off a little bit and then back up, and now look where we're at. We're pretty close to $100. So the 52-week range is $58. Boy, I'd love to see that again, and all the way up to $176 per share. Now, since we're having a market sell-off, I kind of like to see this stock, to see what happens in the next few days, to see if it comes back to that $100 level, because I actually think that's an interesting level for the stock. Now, short interest is 11%, which is not a lot, but it's not insignificant as well. So there's a fair amount of people betting against this stock, and the valuation is $13.75 billion. So we'll see if that $13 billion, almost $14 billion valuation is justified. Let's jump into the numbers. So that's what you want to do if you're a real investor. If you're one of these fly-by-night investors that are buying these airline stocks and Hertz and penny stocks, ignore all this. But if you want to be a real investor, this is what real investors do. They take a look at the numbers. So we'll go by an annual basis, and then I want to jump into the most recent quarter that they just reported, and we'll take a look what's going on in the most current time frame. But first, I want to get a picture of where this company has been and where it might be going. 17, 18, 19, this is year end. We've got platform revenue, which I think includes like advertising and subscription costs, and then we've got player revenue, which I'll show you is not, they really just almost give these players away at cost to drive this platform revenue, which I actually think is a good strategy to do. So we went from 225 million, these are in thousands, so this is 225 million, went up to 416, and then boom, up to 740. So we've seen almost a triple of revenues over just the last 2 years. That is absolutely sensational. If they can continue that, that would be awesome. And so player revenue actually has stayed steady, which I actually think is a pretty interesting sign, that the player revenue is staying steady, but they're growing these revenues. They're sucking more money out of each player and maybe people that currently own the devices as well. And they're distributing Roku through smart TVs and things like that. So they're not quite selling, not everybody's accessing Roku through like a player purchase. So that is very nice. So we ticked up, we noticed we had 500 million in revenue, up to 745, call it, and now boom, up to almost $1.2 billion. So they cracked that $1 billion mark. So again, we can reference the valuation. Again, we're at 13, call it almost 14 billion valuation. So you're paying a lot here. You're paying like 13, 14 times just revenue. But if they can continue this type of growth, I'm sure if you compare this to Netflix and things like that, it's probably not completely out of whack. Cost of revenue, we see here from the platform, it is a very high margin business. They spent $263 million to make $741 million. That is an awesome amount of profit margin. Now, again, like I said, the player revenue is low margin. They spent $371 to get $388. You're almost breaking even at that point on the players. But again, I think that drives a lot of this platform revenue. So we have a total cost here, total cost of revenue of $633. So that gives you a total gross profit here of $495 million. So off $1.1 billion, you're grossing $495 million. That's not bad. That's not bad at all, actually. And so now let's get down to some operating expenses. We see these are growing rapidly as well, especially the sales and marketing. That's jumped up considerably. And back in 17, it was 64 million. Now it's 179 million. So that's quite a growth. It's over $100 million in growth in just a little over a year. We've got total operating expenses at 560. You minus it off the 495 that you grossed, and you get to this net loss of 65 million. So we went from 19 million loss in 17, 13 million loss in 18, and it ticked up considerably, jumped up huge in 19 to $65 million. But again, we cracked that $1 billion mark. So let's look in the most recent quarter. You'd like to see this, the net loss at least stabilize in 2020. And you wouldn't want to see this double, or actually basically 5x'd over the previous year. If this 5x's to $300 million, that'd be a kind of a problem, I think, for investors. First things first, let's take a look at the balance sheet. Like I said, they just lost $65 million, at least from operations, in the most recent year, but they have 500, and this is thousands, this is 588 million, call it $589 million in cash. They have some inventory, some other stuff out here. They have some accounts receivable. They have a fair amount of assets, almost $1 billion here in current assets. They've got a total assets here of 1.5 billion. That's ticked up a little bit, just slightly from the end of last year. So now liabilities, they do have some debt here. We have long-term debt here of 160, call it 163 million. So that's not insignificant debt, but again, they could very comfortably actually pay that off and still have a fair amount of money left over. And I dug into the balance sheet a little bit. They're borrowing this money at 3%, 2%. So I would not be concerned at all with this debt. In fact, if they can borrow more money at that 2 to 3% range, I certainly would do that. And by the Fed, by the position of the Fed, it looks like we're going to have zero rates. And for companies like Roku, they're going to be able to borrow at very, very, very low rates. Now, jumping into the most recent quarter, I'm going to make this a little bit bigger so you guys can see a little bit. So we're jumping right into the most recent quarter here. We have the most recent quarter here, March 31st, year over year, looking at this data. Now, a little bit of COVID-19 impact in this quarter, but I did read the shareholder letter. There's a little bit of a push-pull based on COVID-19. So they saw lots of account activations because a lot of people were obviously staying at home. But they had some advertisers pull away. Cruise lines, airlines, hotels, restaurants, things like that were not advertising in the quarter because they were basically closed. And so if you believe that business will come back, I think Roku will be well positioned to capture that ad dollar going forward. Now, taking a look at the most recent quarter, we were at 134 last year, ticked up to 232. That's the platform revenue. And again, total revenue here of 320. So if you times this by 4, they are on pace to just hit this and maybe even eclipse it by a little bit of about $1 billion. That's if the quarters are all about the same as this quarter that they just had. Coming down to total costs here, $180 million in cost to get $320 million. That gives us a gross profit here of $141 million. Compare that here, and it's very much in line with what they did last year. So we're not seeing like an acceleration of growth kind of month over month here. Of course, this factors in a whole year. We're not seeing that, but year over year, we are seeing a little bit of acceleration there. Now, loss from operations. Again, we have these costs here: research and development, sales and marketing, general and administrative. Those are ticking up again nicely. We ticked up from 111 to 196. So that leads us to a loss from operations of 55 million for the quarter. Notice I just showed you they lost 65 million in a quarter, in a whole year. So they lost 65 million in a whole year. And here they lost 55 million in an entire quarter. So if you annualize this out times that by 4, and they are rapidly accelerating those loss from operations. Now they have the cash on the balance sheet, which we just saw. They could probably borrow some more money, but you would like to see this start to turn around a little bit. But so far, that is not happening. Weighted outstanding shares, they are probably compensating employees very nicely with shares of the stock. And so those have ticked up a little bit as well. So from an annualized basis, again, you can times this, maybe this total revenue, total gross profits. This is not looking good to me. It looks like they're going to lose even more money than they did last year. And then revenue, I would guess, would come in line, if not just slightly ahead. I don't think we're going to see this rapid acceleration like we've seen over the last, call it 2 to 3 years with Roku. I think what I'm seeing here, based on this first quarter here, and this was a good quarter from them from a platform perspective, not necessarily on the advertising side, but on the activation side. I think that this company is going to struggle a little bit with growth this year in 2020. So what would I do if I wanted to buy Roku shares, or if I was thinking about buying Roku shares? Again, what I'm first looking for is this $100 level. That seems to be a natural falling point and kind of natural pop-up point for the shares. So as the market starts selling off, I'd like to see, does this stock stall out in this $100 range? If you get some demand for shares in this $100 range, let's say you have a small account and you're doing fraction shares. I don't mind. You do $30, $50 into Roku. If you have a medium-sized account where you might do $500 to $1,000 in a company like this, well, I wouldn't mind seeing you maybe buy one share when it hits this $90 to $100 level. Because here's the rub. If it breaks this $100 level, there is not much below it to stop it. I would see, honestly, if this stock breaks this $100 level, I could easily see this trading back into the 80s and maybe even down into the high 70s. So you just want to be careful at this level where it's at. There is some upside if things can turn around rapidly. I think there is some upside with this stock, but I think the momentum is not necessarily on your side. But this is a stock I do like. I do like what I'm seeing here. I just don't think we're going to see the rapid acceleration on the top line, and that is going to lead to a larger than maybe even anticipated bottom line losses. I also think it's going to take a while for advertisers to come back, like airlines and travel companies. I think we're going to see a little bit more extended period where they stay on the sidelines with their marketing budgets, which is definitely going to impact Roku. So, but if you can come back in here, if this stock for whatever reason starts trading in that high 70s, high 60s, that's like almost 40% off here. You can take that 40% off that market cap, then it starts making a lot more sense to me from a valuation perspective. And I think your risk reward is just much, much higher. Okay, you buy in at the $60 level, your upside is probably back up into the 150s, 160s, and your downside is probably that COVID-19 low, somewhere in that $50 to $60 range. So manage your risk reward with these things. If you want to inch into Roku, I don't mind it. I would wait to see if you hit that $90 to $100 share mark. And even if you're doing that, I would only develop, say you're doing $1,000 in Roku, I would only do one share at that point. I would do one share and wait. Do another share and then wait, because if it pulls back down into that $60, $70 range, I think you could buy with more confidence. You could buy 3, 4, 5 shares at that point and feel a lot more confident about what you're doing. Not to mention you'd get a much better valuation for your money. So just be patient out there, guys. I know the market's going up and down, and it can play with your emotions a little bit. But if you're a long-term investor, there is nothing wrong with being patient, having stocks on your watch list and seeing where they go. Just when they reach, have a plan. When they reach a valuation and a share price that makes sense to you, be ready to buy, because you can see how rapidly the stock market can go up. So it can rapidly go down, but things can turn around and they can rapidly go back up at the same time. So you have to be prepared for both. So have a plan, be ready, and stay smart out there and do all your own research. And hopefully these videos are helping you accomplish that. If you have a stock you'd like for me to cover here on the channel, leave me a comment below. I'd love to hear from you. Hit that subscribe button, please, if you like what we're doing here, and maybe that like button as well. Thanks for watching. Good luck with your investments.